Two investors see the same crash, the same red candles, the same headline screaming collapse. One whispers, "It's over." The other smiles, quietly. The difference between fear and fortune isn't intelligence, it's emotional discipline. In every generation, history repeats itself. 1929, 2008, 2020. Different numbers, same fear. When panic spreads, money doesn't disappear. It simply changes hands from the impatient to the patient. Because in every storm, a few investors remember one simple rule, a rule that Benjamin Graham called the margin of safety. The real risk, he said, is not that prices fall, but that they never fall below value. In the winter of 2008, panic ruled the world. A young investor named Mark sat in front of his glowing monitor, watching his portfolio bleed. Every tick downward felt like a heartbeat skipped. News anchors shouted, "Recession." Financial commentators predicted the end of capitalism, and social media screamed, "Sell before it's too late." Mark sold everything. The relief lasted 10 minutes. Because deep down, he knew he didn't act on logic. He acted on fear. Meanwhile, someone else was watching the same market collapse. Her name was Sarah. She wasn't fearless, but she was prepared. She had read The Intelligent Investor. She understood that when everyone runs for the exits, the intelligent investor walks in calmly and looks around. She didn't buy blindly. She waited for value to fall far below price. When solid companies traded at half their worth, she began to buy. 1 year later, Mark was still waiting for the right time to re-enter. Sarah was compounding. As Graham wrote decades earlier, the market is your servant, not your master. The margin of safety is not a fancy mathematical formula. It's a philosophy of humility, a reminder that you, the investor, can be wrong. It's the difference between gambling on perfection and preparing for mistakes. If you believe a company is worth $100, you don't pay $100. You wait. You want to buy it for $70 or less. That $30 gap is your emotional cushion, your protection against error, ego, and the unknown. Graham's genius wasn't in discovering a new calculation. It was in recognizing human weakness. He understood that the market isn't dangerous. Our reactions are. The margin of safety was never just about stocks. It was about surviving our own psychology.
Panic is contagious. It spreads faster than any virus. When you see red numbers, your brain activates the same region. It would in a physical threat. Your heart rate spikes, your reasoning shuts down, and survival mode takes over. Graham's insight was simple. Observe emotion, but don't obey it. He said, in the short run, the market is a voting machine. In the long run, it is a weighing machine. Prices fluctuate with popularity, but value endures. The intelligent investor learns to separate emotion from evaluation. When fear dominates the crowd, you ask one question. Has the value really changed, or only the mood?
Most investors never ask that question. They treat the market like an oracle, a divine voice that must be obeyed. But the market isn't divine, it's manic. One day euphoric, the next day depressed. It doesn't know your goals, and it doesn't care about your future. To Graham, the market was a character, Mr. Market, whose moods offered opportunity, not instruction. When he's optimistic, he offers you high prices. When he's depressed, he offers you bargains. The intelligent investor uses his emotions. He doesn't absorb them. Let's look back nearly a century. In 1929, everyone believed prosperity would last forever. The stock market became a religion, and everyone was a believer. Then, overnight, faith collapsed. The Great Depression wiped out fortunes and confidence alike. Yet out of that chaos came a professor at Columbia University who started teaching something different. Benjamin Graham taught that investing was not about predicting the future, but protecting yourself from it. His students, including a young Warren Buffett, learned that true wealth wasn't a reward for intelligence, but a consequence of temperament. Buffett would later say, "You don't need to be smarter than the rest. You need to be more disciplined than the rest." That lesson came directly from Graham. Fast forward to today. The technology has changed, but the emotions haven't. Instead of ticker tapes, we have Twitter. Instead of market rumors, we have algorithms. But the same old fears persist. Fear of missing out, fear of being wrong, fear of losing status. Every day, social media fuels anxiety disguised as opportunity. Buy now. Don't miss this stock. Get rich fast. But behind the noise, Graham's rule remains timeless. An investment is intelligent when it's made with thorough analysis, promises safety of principal, and a satisfactory return. Everything else, no matter how glamorous, is speculation. And speculation is just fear, wearing confidence as a costume. The real test of an investor is not during prosperity, it's during panic. Anyone can look smart in a bull market, but when prices crash, that's when character replaces intellect. When your portfolio drops 30%, when every headline screams meltdown, when your friends text you asking, "Should we sell?" That's your exam. Graham's advice echoes through time. Invest like a realist, act like an optimist. Because optimism without realism is delusion, and realism without optimism is paralysis. The margin of safety bridges both. Hope grounded in arithmetic. So what separates fear from fortune? Not luck, not brilliance, just temperament. The fearful investor reacts. Sell before it's too late. The intelligent investor reflects. Wait. Measure, then act. The first finds temporary comfort and long-term regret. The second endures temporary discomfort and long-term peace. Both live in the same world, see the same charts, hear the same news. But one treats the market as a god to be obeyed, the other as a servant to be employed. Graham's philosophy was not about controlling the market, but controlling yourself when the market loses control. Investing, at its core, is not an IQ test. It's a character exam. Your success doesn't depend on your ability to predict, but on your ability to remain rational when everyone else isn't. When fear takes over, the mind narrows. The world shrinks to the size of your next trade, but Graham's wisdom expands it again. He teaches patience, not passivity, caution, not paralysis. To think like Graham is to leave space between thought and action, between emotion and execution. That space is your real margin of safety. The intelligent investor, Graham said, is one who buys from the pessimist and sells to the optimist. That's not cynicism, it's clarity. Because the market's greatest gift is volatility. It gives you the chance to buy wisdom at a discount. Crashes, corrections, fear. These are not disasters. They are the market's way of testing your discipline. Every panic reveals who truly understands Graham's rule. When everyone screams, "Sell," fortune whispers to those who can stay still. Wealth isn't built in the noise of the market. It's built in the silence between decisions. So the next time the market shakes, remember this. Don't run, don't predict, don't panic. Remember this rule. The market is not your friend. It's your servant. And only those who remain calm long enough get to command it. Because in the end, wealth is not money. wealth is patience rewarded.